Welcome everybody. The fact that you are here means that you must already knew how the insurance liabilities under the general model are measured and how they are measured under the PAA for that matter. But did you know how the numbers are different under these two models? Well, we didn't. And being curious creatures by nature, we did the math, and to our surprise, we discovered that these two models are not that different as the calculation formula could have suggested. This is the 3Blocks webcast on the PAA loss component and the PAA eligibility assessment. We have chosen these two topics as they are conceptually difficult, and many insurance companies still haven't figured out how to deal with these areas in practice. For those of you who don't know us yet, we are an actuarial advisor firm that specializes in IFRS 17 and Solvency II reporting. We haven't organized a web event before, so for us, this is a historical moment, and thank you for signing up and joining us today. We are not going to distribute separately presented slides. However, you will find them incorporated into our IFRS 17 intro presentation that is available at the website. The PAA eligibility check tool that we are going to show today is available at the website as well. The topics presented today are complex and they involve judgment and interpretation of the standard. So, if you don't agree with our judgments, just let us know. Also, please contact us if you have questions or comments, as the webcast is scheduled for 45 minutes, so we are forced to cover these complex topics in a relatively short time. I'm Paweł Woźniak and I have with me Alex Mawson and Agnieszka Hubert. This is the agenda for today. First, Alex will explain the loss component mechanics under the PAA. She will analyze how does it differ from the general model, and she will demonstrate the accounting treatment of the loss component under the PAA. Then we will start a blog dedicated to the PAA eligibility assessment. So Alex will make an introduction to the measurement criterion. It will be followed up by Agnieszka, who will show the 3Blocks PAA eligibility tool that can be used to analyze how PAA measurement differs from general model measurement under realistic scenarios in a realistic setup. Then I will take a closer look at the variability criterion, which is one of the criteria that needs to be met when we want to apply the PAA. And we will conclude our webcast by reiterating key messages or key conclusions.
Thanks, Paweł. I'll now discuss the loss component mechanics under the PAA. So first I will describe the loss component under the general model. Under the general model, the loss component concept is closely related to the revenue concept, which is why we talk about revenue when we talk about the loss component. Total IFRS 17 revenue corresponds to the total premium, and revenue is equal to the release of liability. Therefore, if the release of liability would be greater than premiums, we need to adjust the revenue. To execute these calculations, the general model requires two mechanisms: the liability reduction mechanism and the loss component reduction mechanism. Both mechanisms are typically based on cash flow projections. Loss is recognized in the income statement only at the moment it occurs. Subsequently, it doesn't have any direct impact on the results. The identified loss component is apportioned to future periods to reduce revenue in these periods. It does not impact on the results because the same amounts, with opposite signs, are recognized in the insurance service result. Now we move on to looking at the loss component under the PAA. Under the PAA, the loss component is not needed to adjust the revenue because under the PAA, the revenue is already based on premiums. Explicit cash flow projections are not required under the PAA because the revenue is not based on the reduction in insurance liability. Consequently, the PAA requires neither the liability reduction mechanism nor the loss component reduction mechanism. Here is a comparison of the loss component under the general model and PAA. The slide shows the analysis of movement of the loss component under the general model and the PAA. Under the general model, there are two types of movements: loss recognition or derecognition. Derecognition occurs where losses are lower than originally expected due to a positive change in lapse estimation. And loss component amortization, i.e. the loss component reduction mechanism I previously mentioned. Whereas under the PAA, there is only the movement related to the loss recognition or derecognition. The second important difference is that under the general model, the loss component movements are based on cash flows. Cash flows determine the loss recognition and typically drive the loss component amortization. Under the PAA, the loss component does not require explicit cash flows projections. It may be based on actuarial techniques, giving the value of fulfillment cash flows, but without projecting the cash flows for each period. For example, it can be estimated by applying the ultimate loss ratio to unearned premiums. In the next 3 slides, the colour convention will be that blue journal entries represent amounts measured at the locked-in rate. Green entries represent amounts at the current rate or true up to the current rate based measurement, and grey entries represent nominal undiscounted amounts. First, we will discuss how to account for the general model loss component where the OCI option is not applied. So here, loss recognition at the locked-in rate goes to insurance service cost. If applicable, the true-up effect is recognised as a financial cost. The release of liability related to the loss component goes to insurance service cost, but the financial element of this release is recognised as financial cost. Now we look at how to account for the general model loss component where the OCI option is applied. Here, loss recognition at the locked-in rate goes to insurance service cost, and if applicable, true-up effect is recognised as OCI. The release of liability related to the loss component goes to the insurance service cost, but the financial element of this release goes either to the financial cost or is recognised as OCI. The part that goes to OCI is equal to the true-up to the current rate effect. Now we turn to how to account for the loss component under the PAA. Under the PAA, the situation is much simpler. Because the PAA liability for remaining coverage is not based on cash flows, there is no natural way to strip out the financial cost element of the loss component movement. Consequently, all PAA loss component movements are measured at the current rate. Also, there is no need to separate loss recognition from the release of liability for remaining coverage related to the loss component, as both elements are recognised as insurance costs. Now we'll take a look at one of the measurement criteria. So there are 2 PAA eligibility criteria. The measurement criterion is based on proximity to the general model and variability of fulfillment cash flows. And the duration criterion is based on the insurance coverage period. I will focus on the measurement criterion. I'm going to show you how the PAA measurement differs from the general model using 5 simplified scenarios that include only premiums and claims. As you can see, things like expenses, discounting, risk adjustment, lapses are going to be ignored in these simplified scenarios. Agnieszka will tell you how to estimate the difference between the PAA and general model in a much more realistic setup using the 3Blocks PAA eligibility check tool later in this presentation. In all 5 scenarios, we'll look at a 3-year insurance product. The top graphs show premium, risk distribution, and CSM release patterns. For scenario 1, you can see that premiums, risk distribution, and CSM release are evenly spread over the duration of the product. The table below shows cash flow projections. So for scenario 1, we can see that premiums of 100 each year and claims of 50 each year. The convention is to show liabilities as negatives. The table at the bottom shows the liability for remaining coverage roll forward for each year. So we can see that in the first year, there's premiums of 100, claims of 50, CSM release of 50, and the total revenue is 100, sorry. Under the general model, CSM, which affects revenue, is recognised in proportion to coverage units. The brown numbers signify the relationship between the coverage units and CSM. Whereas, under the PAA, revenue is recognised in proportion to risk distribution. The green numbers signify the relationship between the risk distribution and the PAA revenue. For scenario 1, because the risk distribution and CSM release patterns match, the liability for remaining coverage is the same under the general model and PAA at the end of each year. Now we look at scenario 2. The premiums are all paid up front. We can see premiums of 300 paid in the first year. The risk distribution and coverage units patterns are the same though, so the liability for remaining coverage is the same under the general model and the PAA at the end of each year. Under scenario 3, the premiums are all paid in the final year of the product. Again, the risk distribution and coverage unit patterns are the same. Therefore, the liability for remaining coverage is the same under the general model and PAA at the end of each year. Scenario 4 is a bit different. Here, the premiums are again evenly spread, like they were in scenario 1, but the risk distribution and coverage unit patterns are different. The risk distribution is weighted towards the beginning of the contract. Therefore, more revenue is recognised at the beginning of the contract under PAA. The relationship between claims and CSM release under the general model means that although more revenue is recognised towards the beginning of the contract, it's not to such a great extent compared to the PAA. This leads to differences between the liability for remaining coverage under the general model and PAA at the end of each year. In scenario 5, the risk distribution pattern remains the same as it was in scenario 4, and the coverage unit pattern now matches it. Under this scenario, once again, the liability for remaining coverage is the same under the general model and PAA at the end of each year. I'll now pass over to Agnieszka for an introduction to the 3Blocks PAA eligibility check tool.
Okay, thanks, Alex. Hello, everyone. Before, you've seen some theoretical examples that Alex showed you on the difference between the two measurement models, the PAA and the general model. And now, with the tool we've prepared, I would like you to show you the similar thing, but based on more sophisticated calculations, let's say on the real-life examples. We've prepared that tool, first of all, from curiosity on in which situations we can still use the PAA model for the long-term products. So what defines or in which situations I'm allowed to do it. And second of all, we've made it available for you on our website, so you can try it and see if in your case you can use the simplified model or not. So we've prepared the calculations for 6 different durations, so 10 years, 5 years, etc., up to 1 year. Let's maybe focus on 5 years. The logic in each sheet is the same, but it's just different projection period. And each sheet contains parameters in the top left corner that define your projection. So let's look at the parameters we have. First, we have the first parameters define your outflows. So you can set up claim ratio, expense ratio, acquisition cost ratio. Then you need to set up what is the risk adjustment. The way we modeled risk adjustment here is it's a proportion of PV of claims and expenses. So what you need to set up in the parameters, it's what is the proportion. And then we model premiums. We allow for 4 different frequencies from single to quarterly premium. And then also we included discounting, lapsing of policies, and there is a possibility to model a refund of premium. For instance, when policy for some products it's possible to get a refund of premium when lapsing the policy. So these are the parameters that define your product. But there is one more parameter that is kind of modeling option for the PAA. It's what is the pattern for acquisition cost amortization? Is it risk in proportion to risk or in proportion to time? So when you select that, the whole projection refreshes and you get your results. The summary of differences is presented here in this table, but you can also look at it in a graphical form here. I start with this example. Let's go for the columns, but briefly. There is 5 years of projection. That projection step is a quarter. First, you need to define your coverage units. The coverage units, for instance, if you decide that the sum insured is a coverage unit for the CSM release, you need to put in here the pattern. So I have 1, which means that there is a fixed sum insured throughout the 5 years of projection. Then you need to define as well the risk distribution for the release of PAA liability. So in here, I decided for an increasing pattern. So there is less lower probability of claims happening in the first 2 years, and then increasing probability in the next 3 years. But yeah, it's a pattern that needs to be input here. It's based on your products. Then we model undiscounted cash flows, and this is, for instance, if you select different premium frequency. Let's see how it changes from quarterly to semi-annual. Yeah, it automatically refreshes, and then everything in the differences are different. The claims, expenses, etc. are modeled by us, and then we do the discounting. And later on, we calculate elements of general model, so PV of cash flows, risk adjustment, CSM. The CSM at the beginning is calculated as a difference here, and then the release of CSM is based on the coverage units, discounted coverage units that are provided by the user. So this is a general model projection that's based on like discounting or future cash flows. And the PAA is a bit different because it's not about future cash flows, but it's more like from opening to closing balance, adding premium, deducting acquisition costs, etc. And the key part here is the revenue that is based on the provided risk distribution. At the end, you also have differences per projection step, and then at the end, some checks you may want to look at that later on. So let's start with the first example we had. So I said, Alex also showed you that when you have if you have aligned the way the CSM is released and the way the PAA reserve is released, then there is no difference between the reserve. And if you have that misaligned, there is a difference. So obviously now in my example, these two are different. You have fixed sum insured, that's your coverage unit, and then you have increasing pattern, increasing the risk distribution, so not constant. And then you can see that the differences between the models are well visible. It's not zero. What you can do with the model is you can also check what is the sensitivity of the differences for different parameters, like the lapse ratio. Let's do the 30% lapse ratio. Yeah, it increased actually. Let's do the locked-in rate 2%, from 2% to 5%. Let's say it's not very sensitive. Lapse rate 40%. Yeah, so you can play it with the numbers here, depending on the product and the situation. See and verify whether this is a significant difference or not. Well, okay, and now let's align the way CSM is released and the PAA reserve is released and see what happens in this kind of real life calculations. So let's do the fixed risk distribution, the even. Yeah, so this is the same as we did in the theoretical example, in the first example. And then Alex showed that there is no difference between the two measurement models. And then here you can also see that there is no difference. It's not like this difference is small, it's just there's no difference. So this is a key factor for the difference. So the coverage you need, the risk distribution, so this alignment of the way the reserve is released is a key factor for the difference and for actually deciding whether your product can be eligible for PAA or not. Okay, so this is one thing. Maybe let's do some more sensitivities. Let's see if that changes when I change some parameters. So let's do again the claims ratio, increased claims ratio. Okay, nothing happens. Increased acquisition expenses, nothing happens. Yeah, we can change also risk adjustment, or maybe the way the premium frequency. Yes, so there's still no difference. Okay, and I have also one more scenario to show you, because in the current example, I was focusing mostly on the coverage units and the risk distribution, but there's one more modeling option for PAA you may decide on, and this is the acquisition cost amortization. We had it set to risk, in proportion to risk, but it could be also in proportion to time. So let's see what happens if I change that. So yeah, from zero difference, we end up with a difference for this two, for the product we selected. We can change also some parameters to see if that difference can be reduced to zero. But yeah, from what I was doing and playing with the numbers, I observed that it cannot actually be brought back to zero because of this misalignment between the amortization of acquisition cost in the two models. It can be reduced choosing different parameters, but it will be a difference. Okay, so I think that from my side, that's all I wanted to show you. I encourage you to download it from our website and play with it a bit. If you have other remarks, or if you have some feedback, please let us know. Now let's go back to Paweł for the last part of the presentation. Thanks.
Thank you, Agnieszka. I'm going to talk about the variability criterion, but before I do that, I would like to reiterate all the PAA eligibility criteria. So we've got the measurement criterion that is about proximity of the PAA measurement and the general model measurement. So this was explained in detail by Alex and Agnieszka. Then we have variability criterion that I'm going to cover in a moment. And we've got duration criterion that says that the PAA can be applied if the coverage period of each contract in the group is 1 year or less. So this is by far the most popular criterion when it comes to the PAA eligibility. And many insurance companies just stop there without even considering measurement criterion and variability criterion. And this is actually one of the reasons why we are organizing this webcast, because we would like to encourage insurance companies to consider also measurement criterion and variability criterion and potentially apply the PAA to a broader range of products. This can potentially save a lot of cost and effort, because time and effort needed to implement the PAA is much lower than time and the costs and effort needed to implement the general model. And we should remember that both general model and PAA give very similar results. So why to invest in the general model when we get very similar results under the PAA? So how this criteria looks like. So first of all, it is expressed in negative terms. So in the negative terms, meaning that it says when PAA cannot be applied rather than when the PAA can be applied. So PAA cannot be applied if at the inception of group an entity expects significant variability in the fulfillment cash flows that would affect the measurement of the LRFC during the period before a claim is incurred. So this is Article 54. We can rephrase this criterion in positive terms. So PAA can be applied. So here was cannot be applied, and here PAA can be applied if at the inception of the group an entity does not expect significant variability in the fulfillment cash flows, or the variability in fulfillment cash flows doesn't affect measurement of the LRFC in the pre-claim period. So when we are looking at this criterion in negative form, it seems that variability is central for this assessment. However, if we look at it rephrased in positive form, we can see that even if we have significant variability in fulfillment cash flows, criterion still can be met if LRFC is not affected in the pre-claim period. Yes, so this is alternative. So even in one element of alternative is not met, then the second is met, then the criterion is still satisfied. So the conclusion is even high variability in fulfillment cash flows doesn't infringe Article 54 if this variability does not affect the LRFC. So let me repeat. Even high variability in fulfillment cash flows doesn't infringe Article 54 if this variability doesn't affect the LRFC. Yes. So let's move to the next observation related to this criterion. So many people, including me at the beginning, fall into a trap of thinking that this criterion is about variability in claims. So it's easy to conclude that high variability in claims imply high variability in LRFC, which is not true, because even if we have high variability in claims and but on average it's on the same level, then there's no reason to change estimate of future claims. So so let's consider an example. So let's assume that we are participating in some sort of game, that we've got 50-50 chances of winning or losing. So we are playing this game at a casino. So one day we are losing 1 million euro, another day we win it back. So so even if our wallet experience some fluctuations, it doesn't change the fact that going forward we can still expect 50% chance of losing or winning. So our expected losses going forward in future are not affected by actual losses or gains incurred in the past. Yes. So the conclusion is that even high variability in leak fulfillment cash flow doesn't imply high variability in the LRFC measurement. The next observation is about the CSM capacity to absorb fluctuations in fulfillment cash flows. So the coloring convention is that fulfillment cash flows are in brown, CSM is in yellow, and of course LRFC is the sum of fulfillment cash flows and the CSM. So the first thing to realize here is that LRFC measured at locked-in rate is really not impacted by fluctuation in fulfillment cash flows in case of non-onerous contracts. So this is because, as I said at the beginning, CSM absorbed this fluctuation. So in this case, we can see that fulfillment cash flows has decreased by 20, but this decrease has been compensated by increase in the CSM by 20. So the total LRFC remains the same. It doesn't change at all, so it wouldn't infringe variability criterion then. However, if we look at the very same liability but measured at current rate, there can be some that can be some impact on LRFC, and this impact is related to discount rate changes. So as we know, effects of discount rate changes do not go to the CSM under the general model. So these effects are either recognized as financial costs or go to OCI. So it can be some impact on LRFC in case of liabilities that are discount rate sensitive, and you've got fluctuations of this discount rates. However, in many cases, in case of many products where the PAA is considered as an option, the sensitivity to discount rate is limited. So in these cases, CSM would still absorb most of fluctuations, let's say, considering, let's say, materiality. So to conclude this observation, here we have a conclusion: variability in fulfillment cash flows of non-onerous contracts that are not discount rate sensitive is absorbed by the CSM. Hence, this variability doesn't infringe, let's say, variability criterion, and we can still apply PAA to these contracts. Okay. So this slide summarizes when actually variability criterion can be infringed. Because as explained earlier, in many cases we can still get away with applying PAA. So in my opinion, this variability criterion is infringed in two situations. So I describe this as a situation A and situation B. So in situation is about in situation A we've got a contract that is onerous. So it's onerous, so there is no CSM. If there is no CSM, we have nothing to absorb fluctuations. And high variability of fulfillment cash flow impacts liability for remaining coverage. So if this two, and we've got the situation defined by these two characteristics, variability criterion can be infringed. So the second situation, situation B, we've got contract that is non-onerous, so we've got CSM that can absorb fluctuations, but fulfillment cash flows are discount rate sensitive. So this discount rate changes effects do not go to CSM, and as a consequence we can end up with some fluctuations in liability for remaining coverage. So I think that in those two situations the criterion is not infringed. I'm just curious, what do you think? So if you have some other interpretation, please write to us. All right, this brings us to the end of the webcast. So let me just conclude it by repeating key messages, key conclusions that we try to communicate. So the first one is that full general model functionality for onerous contracts is not required under the premium allocation approach. So some elements of general model can be needed for onerous contracts, but the full functionality, full-blown general model is not needed in our opinion. The second observation is that accounting for the loss component under the PAA is much simpler than under the general model. So we have only one number explaining the movement on the loss component. The third conclusion is that the PAA liability for remaining coverage measurement is different than the general model measurement, mostly when there is misalignment between the CSM release and the risk distribution. So this was explained in detail by Alex and Agnieszka. And last but not least, high variability in fulfillment cash flow doesn't automatically infringe the PAA variability criterion. So these are the things I talked about. So as I said at the beginning, slides from this presentation will be incorporated into our standard IFRS 17 introduction presentation. So this is available at our website. And also PAA eligibility check tool that Agnieszka was showing can be also downloaded from 3Blocks website. And please contact us if you have questions, comments, or feedback on our webcast, or you maybe don't agree with something that you are saying. So we are aware that some of these observations represents interpretation of the standard. So So we are just curious what your interpretation is. So thank you again for joining us today, and maybe see you next time. Thanks.